All right, Matt, you ready to go?
Always ready, buddy.
All right, great. We'll get kicked off and looks like folks are signing on. So good afternoon, everyone, and thank you for joining our February webinar, Exploring Energy and Powering the Future. My name is Mark Riffy, and I am the head of product here at Tortoise, and it's a pleasure to have Matt Salee, our senior portfolio manager, joining us today and head of investments. So these webinars, just as a reminder, they're really designed to just unpack all the complexities that are happening within energy, really in real time. So we do these every month. We're focusing on what's going on beneath the surface, whether it's commodity moves, geopolitics, or potentially structural demand that is influencing energy and ultimately transitioning down to portfolio outcomes. For those who have not been on a Q&A or on our webinar before, just a reminder for Q&A, we'll do that via chat, so you can type in a question at any point in time in the Q&A box at the bottom. And so looking forward to making this as interactive as possible. If you flip to the next page, just got the company overview on Tortoise. Who are we? We're the energy specialists. We've been doing this for more than 2 decades, and really focus on the expertise and on the full energy value chain from wellhead to the end user. Today we have $9 billion in total assets. Then if you go to the next page, you can see our breakout by investment solutions. So we have 7 billion in energy infrastructure investments. Of course, that's where we got our start more than 2 decades ago. But we have transitioned as well beyond just energy infrastructure and midstream. We have $500 million in broad energy strategies. We have 1.4 billion focused on electrification infrastructure, and then we've even broadened out to focus on energy adjacent strategies, whether it be water infrastructure or our more recently launched AI infrastructure. So I would just say that this is an important framing for us. Energy, today remains at historically low weights in the broader S&P 500. So, we see it as foundational to not only economic growth and reliability of power. And we're entering into this demand cycle for AI, but we also think it should play a significant part in investor portfolios. So with that, let us jump to a few poll questions. And we can go ahead and cue this up. Matt's going to talk about performance for the month of January, but we wanted to ask the poll or the attendees, what did you think about energy relative performance versus the S&P 500 for 2026? Do you think we underperform? Do you think we're in line? Do we outperform by more than 10% or less than 10%? We'll just give everyone a second to cue that. Okay, pretty strongly tilted towards outperforming, with just a couple in line and underperforming. And actually, the biggest one was 42% say outperformed by more than 10%. Let's go to the next one. Okay, which fuel source do you believe will be most relied upon to meet hyperscaler demand over the next decade? Hyperscalers being Amazon, uh, Meta, the big four, if you will, and answers are natural gas. The options are natural gas, nuclear, renewables, or coal. Okay, that was Matt. That's near unanimous. Although interesting, we do have a nuclear as well, but 92% believe over the next decade that natural gas is going to be that energy that fluxes up to meet the demand. And then we'll do one more. Okay, what percent of your client portfolios currently are included and focused on energy exposure? Are you at 0%, 1 to 5, 6 to 10, or more than 10%? Okay, man, I think this is a good one to hit on as well. 1 to 5% currently. That's about in line with with the market weight, and then we do have a few that are at 6 to 10%. No one at 0, no one at 10%. So good background of folks joining us today. Just one more slide for me on announcements in our portfolio of investment solutions overall. We don't want to make this about products. We really want to make it about the environment itself. But let me just narrate what our suite of solutions are that we have. We've really built out our ETF platform over the last 15 months or so. So we were 2 ETFs at the end of 2024. Today we're at 7. And really over the last 6 months, we were very busy bringing a few new ideas into the market. So I'll just highlight a couple of those. TCAI, which is our Tortoise Capital AI infrastructure ETF, that's focused on energy, data centers, and digital infrastructure supporting AI. That's seen tremendous growth today. It's sitting over 65 million AUM. And then at the end of the year, we launched 2 ETFs. In December, we had a TMLP. So this is a RIC structured MLP focused ETF. Really, the trick here is we're avoiding the corporate tax drag that traditional C corps have had. And then TNUC, which is our Tortoise Nuclear Renaissance ETF, that is focused on investing across the full value chain of nuclear as that reemerges as a critical resource for base load capacity. So really marking an expansion beyond just traditional energy and energy infrastructure into some more thematic focused in ETFs, and really trying to build a durable portfolio for clients. So Matt, looking forward to your thoughts, and I'll pass it over to you now.
Sounds good. Thanks, Mark. Just starting out quickly, obviously 1 month into the year, energy came out of the gates pretty strong. So we felt good about that. We saw a bit of a reversal of things that had a lot of momentum last year. So energy was not the best performer last year. It starts off the year quite strong. We have seen a lot of macro or strategists across Wall Street forecasting that for the year is outperformance by some underperforming sectors from last year. So again, energy and materials on the top, followed by in particular midstream infrastructure, and then at the bottom, technology was, I think, the second best performer in 2025. Towards the bottom of the list so far this year, and that has continued into February, where energy is performing pretty well here. A little over a week into the month. If we want to flip to the next, just diving in deeper within specifically within energy. On the commodity price side, of course, natural gas prices were a big performer for the month. I'll touch a bit more on that in a second. Oil prices were up quite a bit as well, despite Venezuela putting the Venezuela regime change, putting some pressure on oil prices. More so, that was overwhelmed by geopolitical concerns with what's going on in Iran. So that has led to a pretty big rebound in commodity prices. And I think part of the reason that, in particular, the more commodity price sensitive parts of energy, specifically OFS, which is oil field services, one of the more commodity sensitive parts of the energy value chain, just given that drilling activity increases or decreases with the level of absolute prices. So they were a big beneficiary. Logically, as you might expect, on the bottom, you see still strong performance from energy infrastructure, but weaker part of the energy value chain. And then utilities, which have, basically zero commodity price correlation, at least with oil and natural gas, was, bottom performer, still positive. That was one of the better performers across the S&P last year, though. So all in all, pretty good start to the year, Mark.
A strong start for nuclears as well, Matt.
Yeah, and actually, I noticed this. I think nuclear was actually slightly higher than that. I noticed the refiners and nuclear are both 10.4%. That's not a coincidence. That was a mistake. The nuclear is a little bit higher. I think it was like 11.5%. So very strong start to the year. And a couple of things I'll touch on towards the end, just news wise, that have continued to provide a tailwind for nuclear, both fundamentally and from a technical standpoint. So just touching quickly on our positioning on the next slide. Oh, sorry, I have these out of order.
Yeah.
I mentioned natural gas prices being higher. So why were they up 40%? Well, I think, if you lived in most of the United States, you noticed it was pretty cold late January, and that had a number of impacts really across all energy systems. It impacted production, which is what we're showing on the left. It impacted the refining segment, power generation, power distribution, really all forms of energy. What's interesting if you look at how much production fell off in January, what we're showing there is natural gas. But crude oil had the same impact where the wells get so cold, the hydrocarbons effectively kind of freeze and choke off production coming out of the wells. So that it's temporary, but it does have an impact on production. So it brought production offline. I think it was about 10% for oil and 15% for natural gas. So a pretty big impact there. And we saw that come through also in the natural gas inventory report for the week ended January 23rd, which was really kind of at the very, very early stages of the storm. There was a 242 billion cubic feet natural gas inventory withdrawal. To put that in perspective, that was the 7th largest ever. Obviously, the bigger impact was the following week. So the week ended January 30th, we saw 360 billion cubic feet, which was the largest on record. And we were a little bit above, we were reasonably above historical averages on gas inventory. We're now right back in line with normal inventories. So arguably could be supportive for gas prices throughout 2026. We did see some pretty big temporary price impacts as well. What we show on the right is PJM power prices. That is effectively the largest electricity market in the U.S. In the Northeast. It covers a lot of population, and what you can see there is prices went up, several fold relative to what they typically are, reflecting just how tight capacity margins were. What are capacity margins? That's the amount of capacity you have in a market and how, what was that peak load during the day. So basically not a lot of, you're kind of pushing, getting to, rolling blackouts, and you see prices spike to incent additional generation to come into the grid. Similarly, on natural gas prices, we saw them up, about tenfold in certain parts of the country. On a very, short-term basis, but nonetheless, pretty big price impacts. It'll be interesting as we get into Q1 earnings. We'll see that, come out in Q1 earnings in terms of just some short-term impacts. Again, I don't think it lasted long enough to be a huge impact to anybody, but probably a little bit of excess marketing profits for certain companies that were able to take advantage of that. If we want to flip to the next slide, we'll shift gears a little bit. Another big focus in the market, sticking on PJM, again, the largest electricity market in serving the Northeast. There's basically, I won't get into the weeds here, but there's an auction. They have an auction where you basically bid to put capacity into the market for the coming future years. And what we've seen over the last few auctions is that the blue line there is the amount that capacity prices, basically where the auction cleared. So what did it take for an electricity price that would get the owners of generation to bid into the market? So forgive me, a bit of a technical discussion, but what you're seeing there is prices have gone up several fold. And I'll explain why if we flip to the next slide. In this market, we are at basically the cusp of getting to reserve margins that are really insufficient to ensure that there's reliability, which obviously the organizers of PJM, those that run the market, the regional transmission organization. Again, not to get too technical, but basically their key focus is keep the lights on and do so without, with the lowest possible price. And again, going back to what I talked about, reserve margins are effectively a measure of how much electricity demand is there and how much capacity is there beyond that. So anytime you get below about that 20% reserve margin, that starts to be a bit of a warning signal because obviously electricity demand fluctuates quite a bit, depending on the time of day, depending on weather patterns, all that good stuff. And as we've seen more structural load increase from data centers, as we've talked about, that's pushing those reserve margins down to pretty uncomfortable levels. And that's led to those capacity markets pricing in, requiring much higher prices of power, which is good for the power producers, not as great for the consumers. And it's a concern for regulators, those that are, ensuring the lights stay on. It's caught the attention of the administration, and we have seen now a proposal for federal intervention. There is also support from some of the PJM state governors that in the states where PJM serves. For solutions to bring more capacity into the market to ensure reliability. There's, one of the ideas was what's called basically what they're calling a special capacity procurement. These would be, other interveners, whether it's government or others, basically bidding into the auction to secure or incent additional supply to come into the market. They've talked about longer term contracts, so the capacity auctions are go a couple of years out. They're talking about capacity auctions as far out as 15 years, which would make it easier for providers of generation to make those capital decisions. Because while prices are high right now, it takes a lot longer than a couple of years to build a power plant. So, I think that idea has some merit. I'd say the other thing that I'd say both PJM and the federal proposed interveners argue for are large load tariffs, and effectively what that is it's a way of saying making sure that the hyperscalers in particular, or the large data centers, are paying their fair share for existing infrastructure that they will be a big consumer of. Obviously, there's been a lot of investment over the last 100 years in transmission in that area, and we need to make sure the transmission organizer, wants to ensure that sufficient pricing is being paid for the electricity by these very large consumers to ensure that there's enough investment dollars to build additional redundancy into some of that fixed infrastructure. PJM responded. They're supposed to come out with their recommendation later this month. They also similarly support large load tariffs. I think generally everybody agrees with that. And frankly, the hyperscalers are more than happy to pay their fair share. They want speed to market and, don't want to be blamed as the bad guy for higher electricity prices. And the electricity cost is, it's a big time constraint in terms of keeping their projects from coming online, but it's not a big financial constraint. And obviously these are, extremely well-financed, very profitable, huge companies. So nobody's arguing against large load tariffs. And I think that's going to be a part of the solution. PJM, another thing they're working on is expedited interconnection. Basically what that means is when you're bringing new generation or consumption into the market, you're able to interconnect into the existing grid, effectively connect to the grid. They're looking at ways to speed that process up because it can take up to a few years. But I'd say all in all, PJM is very focused on finding ways to work within their existing market structure with some tweaks. compared to the proposed federal intervention, there's some commonalities with large load tariffs and potentially longer term capacity contracts. So we'll see how all that plays out. I think this chart tells the story. Basically, the reserve margins are getting below a level of comfort, or certainly forecast to in the very near future. A solution is needed, but it's created some uncertainty and it's weighed on some of the power stocks. So we're hopeful to see, it's no change to the long-term kind of macro thesis, but it has caused some headwinds. So we're hopeful to see resolution sooner than later on that. So thanks for bearing with me on a somewhat technical issue or technical topic, but I think it is interesting what's going on. And like I said, it's the biggest power market in the country, so it matters.
Yeah, Matt, certainly an elegant delivery of just the complexities that are, you're kind of dealing with underneath the hood. So let's move on. We're going to hit earnings. We're going to hit portfolio allocations, and then we'll open it up for questions.
Hopefully this section's a little more interesting. I think it's just a little more straightforward story to tell. Why I like to tell the story this way is, Mark showed kind of the array of our products and our strategies. And, I think that makes us unique, that we're doing everything from, we're not investing in the hyperscalers per se, but we're investing in the infrastructure, not just energy, but the infrastructure, whether it's digital or real estate infrastructure that's necessary along with energy to allow AI to get to market. So it's providing a more holistic look at kind of what's going on, in this evolution of the energy market that, is transitioning from a cyclical oil price driven start and stop sort of market to one that is more, the hyperscalers making these, numbers that are kind of unreal to think about a few years ago, and multi-year investments for assets that are going to be in place for decades. So it's transitioning to this secular tailwind that is behind kind of all things digital and energy infrastructure. So I think it's a cool way to kind of think about the trickle down effects. So for 2026, if you look at the big four, Microsoft, Meta, Google, Amazon, their capital expenditures are forecasted based off what, they're guiding to them being up 70% year over year. To put that into numbers, basically they were spending, I think just shy of $400 billion in 2025. That number's pushing $700 billion for 2026. That obviously spooked the market, in particular, for the investors in those hyperscalers, because there's questions around how they will finance those capital expenditures. I don't think that's a big issue because they're still free cash flow positive, even at that spending level, A or higher level rated credit rating on their balance sheet. So I don't think funding is going to be a big issue, but the other big question is just what's the return they're going to earn on those projects. Not to be flippant about it, but for our strategies, it doesn't necessarily matter. We just care that they're spending the money. Because what that does is they're spending money. What are they paying for? They're paying for fiber, routers, servers, all sorts of digital infrastructure, memory, storage. And companies like a Seagate, a Western Digital, Amphenol, SanDisk are, absolutely crushing it on earnings and have backlogs that go out, 5+ years. We're seeing memory prices go up astronomical amounts. And when I say memory, we're talking about like the actual, memory storage of bits, not commodities. And then, what does all that digital infrastructure require along with the chips, which I would group into digital infrastructure? Huge amounts of electricity to power that infrastructure. And we saw on traditional turbines, GE Vernova have another very strong quarter. Their capacity, you can't get a turbine in the next few years, turbine basically to produce electricity from natural gas, which is what GE Vernova makes. They're the biggest in the world. You can't get one anytime soon. So it's great for GE Vernova, but it's also leading to some opportunities for non-traditional power players. So we're seeing companies like Caterpillar or oil field service companies like Baker Hughes, Liberty, Schlumberger, Halliburton get into the power business. And it's like the one lone bright spot. Oilfield services is a tough, it's a tough sector. It's a tough business, but this is kind of a lone bright spot in their businesses because they have the expertise to, use their skill sets, their engineers to provide what's called behind the meter power. And the beauty is it doesn't require connecting to the grid. So you can get to market a lot quicker, and you can actually get, these power, they're basically reciprocating like big diesel motors that actually run off gas, though. So you can get to market fast. Definitely not as efficient as the large scale turbines that GE's making, but it is creating this whole new industry. And as I mentioned, those turbines or reciprocating engines run off natural gas, full stop. So that generation is driving the need for a significant amount of additional natural gas. So again, just kind of continuing with the story, gas infrastructure players like Kinder Morgan and actually hot off the presses today, Williams announced really strong results for the gas transmission parts of their business. Their backlogs for new capacity to serve largely new generation, but also to a lesser degree LNG. Kinder Morgan, I believe now is at about $9 billion of approved projects. Williams talked about a backlog of 15 billion. Now, about 8 of that is actually approved and moving forward, but there's another 7 of projects that they are evaluating. So huge amounts of capital expenditures. What does that mean for Williams? Their growth is as high as it's really been, at least since I've been doing this. So probably about as high as it's ever been historically. And you better have companies, like NextEra, who they're the largest renewable power producer and or developer in the country. Now talking about all the above solutions, which they wouldn't even mention natural gas a couple of years ago, but they're now talking about the need for, kind of all the above solutions to getting reliable electricity to meet growing demand. So it's been a fun earnings season so far, which I guess that kind of makes me sound like a nerd to say earnings season's fun, but nonetheless, it's been interesting to see the kind of pieces flow through and how that impacts more of our traditional holdings like a Kinder Morgan or a Williams, along with some of our newer holdings that are in the AI strategies. So anyway, Mark, that was kind of the high level on earnings and just how it's all flowing together.
Yeah, no, thank you. Good comprehensive overview. So we'll move on from feature topic, and we'll cover just how the portfolios are allocated and have a couple pages on that.
Yeah, I got excited and tried to cover this part earlier, huh? Not much change in the energy infrastructure. We continue to emphasize the natural gas transmission. Obviously, I think it's obvious based off my last slide why we like it. And our broad energy strategy, we have a combination. The upstream allocation you see there in the brighter blue, predominantly all natural gas production. Again, going back to what I just talked about, it's probably obvious why. Liquids infrastructure is our smallest allocation, at least for this strategy. Nothing wrong with it by any stretch, just not as big of a focus, at least here in the near term. You can see power infrastructures, become a bigger allocation really over the last several quarters. And again, similar to the energy infrastructure portfolio, gas infrastructure is our largest allocation. Within electrification, we really express electrification in a couple different ways. Predominantly power infrastructure, which again, going back to what's going on in PJM, very bright outlook there. And then the natural gas infrastructure to a lesser degree that is supporting the fuel for that power production. And then we do have some liquids infrastructure in these strategies, which is really a function of seeing good valuation. And then we like certain parts of their business that are maybe a little more tied to power, basically the electrification theme. So that's the positioning for the energy strategies. And then I believe we included, for our newer strategies that Mark mentioned, how are we positioned for these broader strategies? And for AI infrastructure, we have reduced energy, obviously still big fans of energy, but within this strategy in particular where we have more latitude, or a greater investment universe, we've increased digital infrastructure a reasonable amount over the last quarter. In particular, the storage and memory names like SanDisk, Micron, Western Digital. I mean, it is just phenomenal how much their earnings are growing on a year-over-year basis. So, the stocks have moved quite a bit higher, but the growth outlooks continue to move higher and higher, and the backlogs, go out for a very long period of time. So, pretty interesting part of the story. We've also reduced a bit more of the traditional data centers, the data center REITs, and emphasized more so. We've repositioned within there to more of the Bitcoin miners. And why do we own Bitcoin miners in an AI strategy? Well, they're transitioning their business models to effectively use the electricity capacity that they have and convert that, basically sell it on a contractual basis to provide IT hosting services, hosting services. And there was not only that's driving significant growth in their earnings power, but it's also causing the stocks to re-rate, just given it's a much more stable cash flow stream. On the nuclear portfolio, this is very new. It is a smaller unit. It's a large universe in terms of market cap, just shy of $2 trillion, but it's a pretty concentrated market. So I would expect not as much movement here, certainly relative to the AI infrastructure strategy. We won't have as much movement here across the various pieces of the pie chart. But we do like our strategy in terms of bringing together really the full upstream, midstream, and downstream, for lack of a better, to put it in energy terms. So we have the uranium miners, the upgraders, those manufacturing and designing reactors, and the utilities that are, buying those reactors and producing electricity with them. So that's kind of how we're positioned there. Again, that makes our strategy somewhat unique relative to some other ETFs focused on nuclear that really are emphasizing one part or another of the nuclear value chain. So I'll leave it there. Mark, and turn it back to you.
Yep. No, great overview of the different portfolio positioning that we have across different strategies. You got some time for a few questions, Matt?
Always, Mark. For you, you bet.
All right. One that came in was around U.S. and Venezuela, and do you think the recent entry into the U.S. U.S. entry into Venezuela and the current administration's desire to keep energy costs lower is going to keep prices range bound in that $50 to $60 range? And then how might OPEC be a participant in this market, or is there not much they can do at this point?
Beyond Saudi Arabia, there's not a lot of spare capacity to bring additional OPEC production to market. Now, would they back off if Venezuela significantly ramped production? I'd say that's possible. I think you have to take a grain of salt, take a step back. There's I'd say a misperception in the market, at least based off some of the conversations I've had about, willingness and time to market to bring back Venezuelan barrels. We think there's probably a few 100,000 barrels per day in a global market of 100 million barrels per day, to put that in perspective, that could come back in the next, call it 6 months. Beyond that, I'd say it's going to be 3 to 5 years before you see a meaningful tick up in Venezuelan production. There's been a significant underinvestment and mismanagement of the infrastructure. The infrastructure there, going back the last 10 years. It's going to take time and billions of dollars to rebuild that. And I personally question the willingness of an Exxon or a Conoco to go back into that market after they had, assets that were appropriated away from them. They're still owed billions of dollars from the former government. So, Chevron has continued to operate there. They may have a little more willingness, but there's a limit to how much production they can bring back anytime soon. So, long-winded way of saying we don't see a big impact. Sentiment-wise, we did see oil prices trade off, of course, and I'd say there's some headline risk, or we may hear stories that new production's coming back from those that aren't really making those decisions. So probably some potential noise in the marketplace tied to Venezuela, but nothing, in our view, significant coming in anytime soon.
Okay, good. Actually get one on AI and AI infrastructure, and just can you talk broadly about the valuations given the strong performance?
Yeah, and sorry to do this to you. I'm going to back up a little bit. I gave a partially complete answer. Where we will see an impact in the near term is a benefit to U.S. refiners. So Valero in particular has configured their refineries to run a very low quality level of crude, which Venezuela produces. Why do they do that? Because once you make that upfront capital investment, it's a lot cheaper. So to the extent there is additional near-term oil on the market from Venezuela due to sanctions relief, that will be a benefit, again, a non-recurring benefit or a short-term benefit, but it is a real near-term impact to the refiners. But going back to the question you were asking me, so the AI infrastructure names, as I mentioned just a moment ago, have definitely traded well, and the PEs used to be below the price to earnings ratio multiples used to be below the S&P 500. They're now slightly higher than the S&P 500. However, what has also moved higher is the growth rates of AI infrastructure in particular. As a and the bottom line, as a result of both the valuation and the growth moving higher, you end up in the same place you were a quarter ago in terms of valuation, which you have a PEG ratio for the TCAI portfolio for our AI infrastructure strategy that is just a little below 1.0 times. To put that in perspective, the S&P 500 in total is just a little below 2 times. Lower is better. So basically, it's just your PE ratio over your growth rate, your earnings growth rate. So lower is better. So while you could just look at the valuation on a PE multiple and it may look expensive, reflecting the growth and the duration of that growth, I would argue those names are cheap, at least relative to the broader market.
So that portfolio is trading at more of a 1-to-1, while the broader market is trading at a 2-to-1 pricing.
Yeah.
Okay. Perfect. And then one last one. This is for me, but I know Williams had their analyst day, so I don't know if you guys have any hot takes on. That's one of the obviously the big positions in our portfolios. So if you had any high level thoughts.
Yeah, it was interesting. I haven't looked at where it's trading in the last since we've been on this call, obviously, but all morning it was trading up, between 2% and 4%, which surprised me because expectations were really high going into the analyst day. A lot of Wall Street analysts had taken up their earnings growth rate, and I'll tell you, the punchline is they delivered. Management is now guiding to over 10% annualized earnings growth and cash flow growth through the end of the decade, which just 5 years ago or even less, probably 3 years ago, they were growing at about 5%. So for a energy infrastructure company that owns 100-year life assets to be able to grow at a 10% clip per year was pretty phenomenal. And it just reflects what's going on. They are unique in terms of just being in the absolute sweet spot with having the largest gas transmission network, or arguably the largest, top 3 anyway, across North America. So they're absolutely in the right spot. But to see that level of growth and an energy commodity and infrastructure that is so been built out over the last 100 years is pretty staggering. I think I mentioned this earlier, but they spoke to a total backlog of $15 billion. This is not just natural gas transportation assets. They are also participating in the behind the meter power that I talked about for the oil field service companies. It's interesting. These are the same, basically, again, I refer to them as diesel engines. They're not, but they run off natural gas. They're like big truck motors, effectively. They use those to compress natural gas through and push it through their pipelines. They can use these exact same compressors or engines and put them on site at a data center. They're using a heck of a lot more of them, obviously, because there's a lot more power required. but they can get speed to market. So their first project's coming on. I think they have one coming on late this year, a couple more coming on throughout 2027, another one in 2028. So that's become a big part of their backlog. Like we're talking several $billion. They have long-term contracts, so 10 to 12-year contracts for fixed price. So it's arguably as high quality as pipeline volumes, where they're earning a fixed rate. So it's a pretty interesting part of their business, and effectively what they're doing is they're putting these engines out there that consume gas, so it helps to keep the pipelines full too. So they are unique. I think they're the one. I can't think of another midstream player. They're definitely the only midstream player that's really adopted this strategy and embraced it in a big way, spending billions of dollars. There may be some others kind of flirting with the idea, but they've definitely differentiated themselves, and their shares have traded well this year and continue to trade well as a result. And we think justifiably so. Their backlog, their forecast, our forecast for them has never been this strong.
Yeah. Awesome. Well, thank you. I figured you'd have a good answer for
I'm pretty biased on this one, but you're right. It is one of our biggest holdings, and there's a lot. It's hard to find things to poke holes in with the name.
Yeah. Good. Okay, that wraps up the questions I saw. So just to wrap up, Matt, thank you for all the comments, great insights. March 10th is going to be our next monthly webinar. As you guys see, we'll really unpack everything that's happening within energy and related topics. So any questions, do feel free to reach out to the sales team. You can see them all posted here and your contacts, and we'll be happy to talk further or answer any additional questions that you might have. So to our audience, thanks for joining, and we'll talk to you next month. Thanks, Matt.
Thanks all.